Hey everyone, it's Caleb Franzen with Cubic Analytics. You might be surprised to see my face again. It's been multiple months since I've done a video, but I'm back. I'm back, baby. No, but in all seriousness, it's a big goal of mine this year to put more effort into YouTube videos, doing more analysis where I'm sharing kind of some in-depth ideas with you guys. So if you appreciate the effort that I'm putting in here, if you like the analysis, just do me a favor, let me know, leave a comment, drop a like, share this with a friend or a family member, maybe a colleague. Hey, I don't know. But let's get right into it because I have some interesting Bitcoin analysis I want to share with you guys. Like I said, it's been a while since I did a video, so I wanted to come back with a banger. So what are we looking at here? We're looking at Bitcoin all-time monthly candles, but in the lower bound, I've added the 12-month Williams %R oscillator. We're going to go through a couple different versions of this particular study because I think it's super important right now. What's the key thing to look at right here? I want to focus specifically on this oscillator. Why are we looking at 12 months? Hey, that's 1 year. So what this allows us to do is to measure and evaluate where Bitcoin is trading relative to its 1-year trend. And historically, we can see during bear markets, we cross below this lower bound threshold, which is the oversold indicator. And within a long-term uptrend, when something is oversold, that's probably a good time to accumulate that asset. And we can see that distinctly in the chart, right? So here was the 2011 bear market, great accumulation zone. Here was the 2014-15 bear market, great accumulation zone. Same thing with the 2018-19 bear market. And what we can see is that each time we've left this oversold level and we've crossed out of there, that's been the end of the bear market and essentially the birth of the new bull market, right? And so I was warning about this in June of 2022 as we crossed below here saying, hey, this is statistically an accumulation zone. And so sure enough, that's exactly how I interpreted it. That's exactly how I navigated it with my portfolio. And I used this opportunity to be buying Bitcoin in this historic accumulation zone. The key thing to be pointing out is for the first time now since that May cross down, right, that monthly candle for May, we're leaving that accumulation zone as of the January 2023 monthly close. It's a little bit shaky here with the February candle. We've obviously seen a little bit of a pullback in the price of Bitcoin. I think we got as high as around 23,000 and we've pulled back into, we wicked to about 21.3, 21.4K. So a little bit of a pullback here, a little bit of a consolidation, but this signal is giving us, a verifiable way to validate, hey, we might be moving into a new bull market. Why do I have some pause about this still? Is because another indicator that I've been warning about is looking at is the 18-month Williams %R oscillator. And again, if we zoom out, again, 18 months, why are we looking at 18 months? It seems arbitrary. I promise you it's not. 18 months is a year and a half of price data. So again, this helps us to really get a good indication of the long-term trend here. And so 18 months, we're seeing the same kind of effective signal. Accumulation zones once we're below this range. Accumulation zone, accumulation zone, accumulation zone. While the 12-month oscillator has actually been able to achieve a crossover, we haven't gotten that yet with the 18-month. So we can be encouraged by the signal that we're seeing with the 12-month indicator, but once this 18-month gets the crossover, it's going to strengthen the bullish argument. We're not there yet though. So once again, this is why I have a little bit of pause around the current price dynamics. And we'll zoom in a little bit here in just a second to take a look at some of the more short-term indications in what I'm seeing in the market. But I would definitely want to highlight this 12-month and 18-month kind of divergence that we're seeing here. We're not getting the follow-through yet in the 18-month indicator. One more that I've been looking at, and I actually haven't pulled this up in a while, so I'm curious to see how this looks, is the 24-month. 24 months is 2 years. We had a little bit of a fake breakdown here almost in that month of June, but snapped right back up, and now we've been oversold, right? Once again, this is a much smoother indicator. We're looking at 12 months, 18 months, 24 months. Because it's the longest one, we would expect to see that move a little bit more slowly. We didn't even officially get a crossover here in that 2011 bear market because the indicator was too young, right? So take this with a grain of salt. But once again, we're still seeing this validate these accumulation signals. Hey, that's a great sign. But once again, similar to the 18-month now, it doesn't look like we've actually achieved that crossover yet. So perhaps some room for caution. One other reason for caution, one more, we're going to stick with the Williams %R oscillator, is looking at the 48-month. We could see in the past 2 bear markets, we've actually crossed below this oversold level. That happened in the 2015-16 bear market, or let's just call it 2015 bear market. It happened at the tail end of the 2018 bear market going into 2019. But we actually haven't achieved a crossover yet. We got super close there in the month of December when prices were very suppressed. I think we were trading right around 17,000, right? And we didn't actually achieve that crossover yet. So perhaps if history repeats, we've seen bear markets cross below that oversold threshold. We're not there yet. Maybe we don't actually get there. So, hard to say, but as of right now, this bear market, we haven't been able to check that box yet. What I want to do really quickly is zoom into some of the daily price action here. And I want to highlight, we'll still look at the Williams percent R oscillator. And a lot of this stuff I've been posting on Twitter, some of it, not all of it. So if you're not following me there on Twitter yet, let's go ahead and change that at Caleb Franzen. It's just my first and last name. We're growing super fast over there, so come check out what we're doing. What I want to do here, let's modify this to 60. Why 60 days? That's 2 months of price data. So it gives us a pretty good indication of the short/medium term trend, right? It's not perfect. Nonetheless, though, what we can see is that when we've been able to cross back below the oversold threshold, the overbought threshold, this top line here, this has led to a new leg lower, basically in each of these crossovers. Right? And what happened, I outlined this in real time, is that we got that crossover last Thursday. And I did a post about this in my newsletter over the weekend, talking about the drawdowns that we've witnessed in each of these signals after the signal was put in. So what we had here was a 48% drawdown. In the next one, we had a 60% drawdown, let's call it. And then in the final signal that we got in the bear market cycle, we had a 33% drawdown. We're getting that signal again now. The one thing that I've warned about, as you can see with all of these other prior crossovers, what's happened is we've basically just had a straight line shot back down to the oversold level, right? We haven't seen in any of these signals an instance where the indicator goes back to being overbought, right? And that's potentially what's happening right now, right? We've had a massive resurgence with today's CPI data. Definitely something to have on our radar. Buyers are putting conviction forward here, right? We're trading at 22,000, let's just call it 200 essentially. Earlier this morning, we were below 22,000. So pretty big snap back here. I think even in the morning session, we got as low as 21.5K. So really strong kind of signal here in terms of a resurgence in buying activity. But nonetheless, I don't think, at least as of right now, this signal is not invalidated yet unless we get back above this overbought level here, this upper bound. So we're not there yet. Overall, let's tie this in to kind of some of the macro related dynamics, because what we're seeing generally is risk assets, especially today, are performing very, very well. The S&P 500 was basically flat today, down 0.03%, essentially a nothing burger. However, when you look at the more risky segments of the market, the NASDAQ was up 0.7% today. ARK was up 2.5% today. Tesla had a very strong day, up 7.5%. So we're having the riskiest segments of the market celebrate and grind higher, whereas something like the Dow Jones, something very defensive overall, has not had the follow through, right? This was actually down almost 0.5% today. This was a scenario I was outlining for my Cubic Analytics subscribers for the newsletter, looking really here at this kind of cup and handle structure for the Dow Jones. And I was talking about how, I think I was talking about it back in here in this range, saying, look, if and when we can get a breakout, I might have even done it on this candle, but if and when we get a breakout, so far we have not been able to produce that breakout. If anything, this handle phase of the cup and handle process has just been elongated, right? We actually haven't seen any indication of whether or not are we in a bull market, a bear market, what's the trend here, are buyers, are we continuing to see a massive follow through in demand? Well, the Dow Jones isn't telling us that. We're not seeing that from the Dow, right? And considering the fact that the Dow Jones really showed a lot of leadership, especially in the second half of 2022, the fact that we're not seeing any conviction there is certainly a potential sign of concern, at least in my opinion. The one other thing I want to talk about really quickly is what's happening in yields, because essentially what we're seeing is that yields aren't budging, and if anything, they're just trending higher and higher. Today we had the 3-month Treasury yield hit new, essentially multi-year highs, the highest level since August or July of 2007. When we look at the 6-month Treasury yield, this crossed over 5% today for the first time since 2007. So again, we're not seeing any demand for short-term bonds here, which in my opinion essentially indicates the Fed, at least the bond market believes the Fed still has much work to be done, right? There's still a lot of work left in the tank, still a couple rate hikes left to go. We're seeing CME futures continue to price in multiple 0.25% rate hikes in the months ahead, and the bond market is confirming that. So, equities, crypto, they have the ability to skate to where the puck is going. Same with the bond market. And what we're seeing right now is a lot of mixed signals, especially after such a historic run to start 2023. We've been on this massive upswing here. In my opinion, what we're seeing is essentially indicative of the fact that we should be taking some chips off the table, but potentially be encouraged by the fact that we're seeing strong underlying data, right? Looking at that 12-month Williams percent R oscillator, at the same time acknowledging the fact that we're not checking all the boxes for bullish indicators yet. Are we close? Yes, but we're not there yet. So I'm gonna cap the video off here, guys. Hopefully I'll be doing at least a video a week. If you like this kind of content, let me know, guys. I'm gonna really need your support and motivation here to get going back on YouTube. I had a lot of fun doing these in mid to the tail end of 2022, but I wanna hit it again hard this year. So let's make it happen, guys. Tell me what you think. Peace.